learn everything you need to learn about the basics of technical analysis in a structured, simple-to-follow, step-by-step way. We'll begin with a simple introduction to what technical analysis is and its goals, and then we'll jump right to the main techniques for beginners. By the end of this course, you should be able to combine different basic techniques to produce good trades on your own, and then you'll be ready to continue your trading education with other techniques for intermediate and advanced traders. If you're new to this channel, make sure you click the like button, subscribe to the channel, and activate the notifications button. By doing this, you support the ongoing creation of free videos like this one. Let's begin with the definition of technical analysis. Technical analysis is the use of price charts to identify repeatable patterns in past price information in order to forecast the future of price. That allows traders to identify trade opportunities where they can buy low and sell high, which is the main goal of a trader. Technical analysis only works because the financial markets are made of repeatable patterns. When a trader is able to spot a known pattern developing in real time, he's able to know what's going to happen with the future of price. In other words, technical analysis is all about learning how to spot the many different repeatable patterns of the market. In this course, you'll learn the most basic of these patterns, but keep in mind that there are many more patterns from beginner to advanced level. The main tool of technical analysis is the price chart, so let's quickly explore the main features of the price chart. As a beginner, you must know 4 elements of price charts: the symbol or instrument, the type, the time frame, and the auxiliary tools you can add to the price chart to enhance your analysis. The symbol, also known as the instrument, is the market that you want to trade. For example, in TradingView, you can choose between stocks, futures, forex, crypto, and so on. These are the different types of symbols. Let's say you want to trade forex. You click on the forex tab, and then a list of forex symbols will open. By clicking in one of them, like the Euro USD, you will open the Euro USD price chart. The next element of price charts you must know is the type of price chart. There are many different ways of displaying price information in the chart. The vast majority of traders use the candlestick chart because it's very useful, but as you can see here, there are many other types of price charts. As you progress throughout this course, you'll understand why most traders choose the candlestick chart to trade. It has many useful properties that are also easy to use. Each one of these bars that appear in the chart is a candlestick, and we'll talk a lot about them throughout this course. Notice that the x-axis of the chart represents the passage of time, and the y-axis of the chart represents price fluctuation. The next thing you must know about price charts is the time frame. The time frame of your price chart controls how much time it takes for a candlestick to form. For example, if we are in the 1-hour chart of the Euro USD, that means that each candlestick in this chart takes exactly 1 hour to form. When 1 hour passes by, another candlestick begins to form in the chart. As you can see here, there are many time frame options. You can choose from 1 second all the way up to 1 month. In the 1 second time frame, each candlestick will take 1 second to form. In the monthly time frame, each candlestick will take 1 month to form. Notice that you can see the same symbol or instrument in many different time frames. The daily time frame will practically be a different market than the 1-minute time frame, even when we are talking about the same symbol. The time frame you will choose depends on how much time you want to wait for opportunities to align, how fast you can analyze the market in real time, and how much time you have at your disposal in order to trade. In a very fast time frame, like the 1 minute for example, the market develops very quickly, so you must be very skilled. In a slower time frame, like the 4-hour for example, the market develops slowly, so you have a lot of time to think about your analysis and trade decisions. It's important to notice also that the smaller the time frame, the smaller the price movements. So even though a time frame like the 1 minute develops quickly, the size of price movements is small. A time frame like the daily, for example, develops slowly, but the price movements are much greater. The last element of price charts you must know is that beyond price itself, which is formed by the candlesticks, traders will often add other tools to enhance their capacity to analyze the market and detect the repeatable patterns I mentioned previously. There are mainly 2 ways of doing this. we have what are called overlay tools, and we have window oscillators. Overlay tools are any type of technical indicator or line that is plotted on top of price. For example, I can plot technical indicators, which are mathematical formulas applied to price, like moving averages and Bollinger Bands. You do this by opening the Indicators tab and then selecting the technical indicator you want to use. Notice that these indicators are plotted on top of price. That's why they are called overlay tools. There are other types of overlay tools that are not technical indicators. They are different types of lines, like horizontal lines or sloped lines, for example. I can also make use of window oscillators, which are technical indicators that are displayed in a separate window, usually below price. This is the case with indicators like the RSI, the MACD, or the stochastic indicator, for example. You open these in the same way that you open the overlay tools, which is by clicking on the Indicators tab and then selecting the window oscillator of your choice. There is another interesting possibility here that I'm going to briefly show you to spark your curiosity, even though this is not exactly a beginner's thing. You can also use overlay tools on top of window oscillators instead of price. For example, you can draw different types of lines or even apply different types of indicators on top of window oscillators. There are hundreds of possible combinations and techniques here, but that's a subject for another video. For now, I just want you to know that you can apply different tools on top of candlesticks or below them in order to enhance your analysis. In this course, you'll learn a few of the simple ways of doing that effectively. The next step here is to learn more about the fundamental piece of price charts, which is the candlestick. There's a lot of useful information contained in candlesticks, and by understanding how to read this information, you will be able to gain further insight about the market you want to trade. This is the first step in learning how to identify the repeatable patterns of the market. Let's begin with the very basics of candlesticks. Any candlestick is formed by 4 values, also known as 4 prices. These are the open, the high, the low, and the close. Remember that I said that the time frame you choose controls how much time it takes to form a candlestick on the chart. For instance, on the 1-hour time frame, it takes 1 hour for one candlestick to form. The 4 prices will tell a story of what happened with the market within that chosen period. There are mainly 2 types of candlesticks: the bullish and the bearish candlestick. The bullish candlestick occurs when the closing price is higher than the opening price. The bullish candlestick is usually displayed as a green candle on the chart. The bearish candlestick occurs when the closing price is lower than the opening price. The bearish candlestick is usually displayed as a red candle on the chart. Let's take the example of a bullish candlestick first. Imagine that we are looking at the 1-hour time frame once again. The green box represents 1 hour, and the yellow line represents how price fluctuated within that hour. The opening price is the price at the beginning of the hour. The closing price is the price at the end of the hour. The low is the minimum price that the market reached within the hour, and the high is the maximum price that the market reached within the hour. This is where the 4 prices come from. The distance between the open and the close is displayed as a thick bar, known as the candle body. In the case of a bullish candlestick, the distance between the open and the low and the distance between the close and the high are displayed as thin lines, also known as candle wicks or candle shadows. The distance between the low and the high is known as range. The bearish candlestick works in the exact same way. The only difference is that the close is lower than the open. The wicks or shadows are formed by the distance between the open and the high and the close and the low. Notice also that this is true for all time frames. Candlesticks can form many different shapes, and each one can have a particular meaning. This leads us to the idea of candlestick patterns, which are patterns of one or more candlesticks that repeat themselves over and over in the market, and they have a particular meaning and a particular name that helps memorizing them. In this video, I will not talk about all the candlestick patterns because there are more than 50 of them. If you want to get deeper into the study of candlestick patterns, I made a video called The Ultimate Beginner's Guide to Candlestick Patterns, which you can check out in the YouTube card. In this video that you are watching right now, I will give you a few examples only because we have other elements and techniques to cover. As I said, I will give you simple and yet powerful examples of candlestick patterns in this video so you can get a feel of how they work. Candlestick patterns are specific candlestick shapes or combinations of specific candlestick shapes that indicate what's going to happen with price. The first thing to know here is that there are candlestick patterns that indicate a future reversal in price and patterns that indicate a future continuation in price movement. The most useful candlestick patterns are the reversal type. These patterns usually have a bullish version and a bearish version. The term bullish indicates upside and the term bearish indicates downside. So for example, when there is a bullish reversal pattern, price will be going down and then a pattern will appear to signal a reversal to the upside. By the same token, in a bearish reversal pattern, price will be going up and then a bearish reversal pattern will appear to signal a reversal to the downside. In a bullish continuation, price will be going up and then a pattern will appear to indicate a continuation to the upside. In a bearish continuation, price will be going down and then a pattern will appear to indicate a continuation to the downside. Let's begin with an example of a reversal candlestick pattern called harami, which is also known as the inside candle. This is a candlestick pattern formed by two candles. The main thing to look for here is related to the range of one candle in relation to the range of the previous candle. The rule is that the range of the second candle must be completely inside the range of the first candle, hence the name inside candlestick. An inside candle simply means that price has stopped advancing, meaning that it is now stationary. That can indicate a reversal. This is the shape of a bearish harami or a bearish inside candle. The most recent candlestick will usually be bearish, but there can be exceptions. Take a look at this daily chart of the British pound versus the US dollar. I have marked the range of the last two candles, the first one in black and the second one in red. Notice how the range of the second candle is completely contained inside the range of the first one. Notice also how price has been rising up to this point. This is a bearish harami or a bearish inside candle that signals a reversal to the downside. In this other image, you can see what happened with price right after the bearish harami pattern. It went straight to the downside just like the pattern anticipated. Let's observe now an example of a bullish harami or a bullish inside candle. This illustration shows that the most recent candlestick in a bullish harami will usually be bullish, but there can be exceptions. In this chart, we have the 1 hour time frame of the S&P futures. I have marked the range of the last two candlesticks in the same way I did in the previous example. Observe how the range of the current candle is contained within the range of the previous candle, therefore creating an inside pattern. Price was going down, so this is a bullish harami pattern, meaning that price will be going down and then the pattern will appear to signal a reversal to the upside. Let's see what happened with price right after the pattern. In this chart, you can see how price immediately reverses to the upside after the bullish harami or the bullish inside candle. The next candlestick pattern I want to talk about is called shooting star, and it's a bearish reversal pattern that is also very common and very reliable. Since it's a bearish reversal pattern, it appears when price is going up in order to signal a reversal to the downside. The shooting star is made of only one candlestick, so we have to pay attention to the specific properties of this candlestick. The shooting star has a small bearish body, a large upper shadow, and a non-existent or very small lower shadow. This is a bearish reversal pattern because the candlestick opens, then goes to the upside at some point during the formation of the candle, as it is shown by the large upper shadow, and then price closes lower than the open. All of this means that price went up a little bit and encountered powerful sellers in its upper range. In this chart, we have the 4 hour time frame of Bitcoin versus the US dollar. I marked a clear shooting star pattern after price has been rising for a while. In this next chart, you can see that the price went down immediately after the appearance of the shooting star pattern. The bullish version of the shooting star is actually called hammer, and it has a small bullish body, a large lower shadow, and a non-existent or small upper shadow. The interpretation is the opposite of the shooting star. The candlestick opens, then goes to the downside at some point during the formation of the candle, as it is shown by the large lower shadow, and then price closes higher than the open. All of this means that price went down a little bit and encountered powerful buyers in its lower range. In this chart, you can see the 5-minute time frame of the US dollar versus the Japanese yen. As you can see, I marked a classic hammer formation after price has been going down. In this next chart, you can see how the hammer indicated a reversal to the upside with good accuracy. Notice also how I'm giving you different examples in different markets and different time frames, so you can get used to the fact that these patterns work in the same way in any price chart you analyze. Another powerful candlestick formation I want to show you is called the outside candle, also known as the engulfing pattern. This is the opposite of the harami or the inside candle in a way. This is a pattern formed by two candles. The main characteristic here is that the range of the second candle must engulf the range of the first one. The pattern indicates that price will go in the direction of the engulfing candle. In this outside formation, a bullish candlestick will engulf the range of the previous candlestick, as you can see in this illustration. In this image, you can see the 5-minute time frame of the Canadian dollar versus the Japanese yen. Notice that the current candle has a range that completely engulfs the range of the previous candle. And also, the current candle is bullish, implying that there will be a reversal to the upside. Immediately after the engulfing pattern or the outside candle, we can see that the market started to go up. We also have the bearish version of the engulfing pattern. In this illustration, you can see that a bearish candle completely engulfs the range of the previous candle, therefore indicating a reversal to the downside. In this image, you can see the 45-minute time frame of the German index. Notice how the range of the current candlestick completely engulfs the range of the previous candle, and how the current candle is bearish, indicating a reversal to the downside. In this next chart, you can see how the bearish engulfing pattern, or the outside candle, indicated a reversal successfully. As I said previously, these are just a few examples of what candlestick patterns can do, and if you want to dive deeper into the subject, you can watch the other video I created entirely dedicated to the subject. Notice that we began analyzing the elements of an individual candlestick, then we moved on to patterns formed by one or two candles. The logical step here is to learn what happens when we broaden our view of the price chart and observe the patterns formed by collections of candlesticks. This leads us to the idea of highs and lows. Anytime you open a price chart, two things become obvious right away. You notice that there are candlesticks in the chart, and that these candlesticks form peaks and valleys, or highs and lows. Your ability to recognize these highs and lows is essential for most good trading strategies out there. For example, take a look at this chart. There are around 160 visible candlesticks in here. And notice how distinctive highs and lows form as new candlesticks are formed. It's always useful to mark these highs and lows, as you can see in this next chart. If we mark the highs and lows and then erase the candlesticks from the price charts, you'll be able to see how there is a certain structure in the market. Being able to identify highs and lows in the price chart is important for a few different reasons. 1. You can establish the overall trend of the market by looking at the highs and lows. 2. You can identify what are called support and resistance lines. 3. You can identify chart patterns. 4. You can detect the strength behind price movements by comparing highs and lows in price with the highs and lows in certain technical indicators. Don't worry if you don't know what all of this means, because we'll talk about each one of these 4 elements right now. Let's begin with the overall idea of market trends. We have basically 3 types of trends that can happen. The bull market or uptrend, which is when prices are going up. The sideways market, which is when prices are moving sideways or in lateral motion. And the bear market or downtrend, which is when prices are going to the downside. We can detect each one of these types of trends by looking at what highs and lows are doing in the price chart. Let's first observe what happens in a bull market or uptrend. In an uptrend, prices rise because buyers have more power than sellers, so the upward price movements are larger than the downward price movements. This creates the main characteristic of uptrends, which is the presence of higher highs and higher lows in the price chart. Higher highs mean that buyers are strong enough to create progressively higher levels in the price chart. Higher lows mean that buyers are progressively starting the new upward price movement at a higher price. In this chart, you can see a real example of a clear uptrend or bull market. Notice how there are higher highs and higher lows throughout the entire trend. The next type of trend will be the sideways market, which is characterized by roughly equal upward and downward price movements. This means that buyers and sellers have around the same strength. The sideways market is marked by flat highs and flat lows, as you can see in this illustration. In this chart, you can see a real example of sideways market. Notice that in real charts, the flat highs and flat lows are not perfect. What matters the most here is the overall aspect of highs and lows. In a downtrend or bear market, the sellers are more powerful than buyers, so the downward price movements are larger than the upward price movements. That generates the characteristic effect of downtrends, which is lower highs and lower lows, as you can see in this image. The downtrend is basically the mirrored image of the uptrend. In this chart, you can observe a real example of downtrend or bear market. Notice once again the lower highs and lower lows as the main characteristic in here. This finishes off the overall idea of trends by looking at simple highs and lows in the price chart. We can now move on to a different use of highs and lows, which is to help in the identification of support and resistance levels. Support and resistance levels are horizontal barriers in the price chart. These barriers can be useful for identifying reversal points in the market. When price is below a barrier, we call it resistance. In this chart, you can see an example of resistance. The first high sets a barrier for price, and then when price comes back to this level, it treats it as resistance, only to reverse to the downside right after. When price is above the barrier, we call it support. In this price chart, you can see an example of a support line. Notice how price touches the line 3 times, and then it reverses to the upside. In other words, the support line acted as a barrier. When this barrier is strong enough, price reverses direction after hitting it. You identify support and resistance lines by connecting highs and lows together with horizontal lines. There are 2 important properties of support and resistance lines. 1. The greater the number of times that price respects a support or a resistance line, the stronger the barrier. 2. Support and resistance lines have a switching quality, meaning that a support line that is broken becomes a resistance line, and a resistance line that is broken becomes a support line. In this chart, you can see an example of these 2 main properties in action. Notice how price tests the black line as resistance a few times on the left side of the chart. In the middle of the chart, price breaks the line to the upside, and now what was a resistance line turns into a support line, as we can see in the right part of the chart. Price then tests the same line as support 2 times and reverses to the upside right after. In this other chart, we can see the opposite happening. In other words, a support line turning into a resistance line. Another way that a trader can use candlesticks and highs and lows is by identifying chart patterns. Chart patterns are collections of highs and lows that form particular shapes in the price chart. These shapes can be used to indicate a reversal or a continuation in the price movement in the same way that candlestick patterns do. In this video, I will only give you a few examples of chart patterns because, like candlesticks, there are many different patterns to learn. If you want to go deeper into the study of chart patterns, you can watch my Ultimate Beginner's Guide to Chart Patterns in the YouTube card or in the video description. Chart patterns can be classified into 2 main categories, just like the candlestick patterns: the reversal and the continuation patterns. One of the easiest and most reliable chart pattern is called the double bottom, which is a bullish reversal pattern, meaning that price will be going down, and then a double bottom will appear to indicate a reversal to the upside. There's a very simple logic behind the double bottom. A double bottom happens when price stops making lower highs and lower lows, and now price creates a low that happens at the same level as the previous low. The logical interpretation of this is that now sellers are not able to create a low that is lower than the previous one, and therefore, sellers are losing strength. If sellers are losing strength, buyers are gaining strength, which might indicate a reversal to the upside. I will show you a classic way of trading this pattern, and I will show you an alternative way of trading this pattern using what we have learned so far about candlestick patterns. Take a look at this chart of the 4-hour time frame of the US dollar versus the Canadian dollar. On the left side, we can see that price was creating lower highs and lower lows, which is typical of a downtrend. In the middle of the chart, sellers attempted to create a lower low, but they failed. Observe how this low is in the same level as the previous one. That's what begins to form a double bottom formation. Observe also that the candlestick that forms the double bottom is a hammer-like candle. That bullish body and the prominent lower shadow mean that there are some buyers in the level of the last low. This is typical of a double bottom formation also. More advanced chart pattern traders will anticipate that this is a double bottom right at this point and trade right here without waiting for the classic confirmation that this is indeed a double bottom. Notice also that price began to create flat highs. By connecting the highs, we create a resistance line that will serve as a confirmation for the double bottom pattern. The confirmation for the double bottom formation relies on the fact that when price breaks out a resistance line, it starts to treat it as support line. This is exactly what happened here. Price clearly broke the resistance line and then came back to test it as support. This is the moment where classic chart pattern traders will pull the trigger. Notice how the first time that price tests the support line, there's a larger lower shadow indicating the presence of some buyers. Right after that, we see 3 consecutive inside candles, and finally, an outside candle pointing to the upside. What I want you to take away from this example at this point is that chart patterns provide some sort of map to traders in the market. The double bottom is a bullish reversal pattern. The bearish version works in the exact same way, but everything is upside down, and it's called a double top. Let me show you a variation of the double top called triple top, which is the same pattern, but price attempts to surpass a certain level 3 times instead of 2 like in the double bottom or double top. In this chart, you can see a double top formation that ends up becoming a triple top formation. The first red arrow shows the origin of the resistance line coming from a prominent high in the chart. The second red arrow shows the moment where price comes back to the resistance line. Notice that when price touches the resistance line, it creates a candlestick with a prominent upper shadow and a bearish body. This is the shooting star pattern we saw previously, which is a bearish reversal pattern. In other words, price creates a bearish reversal candlestick pattern at the same time that it hits a resistance line, and right after that, price goes to the downside. Chart pattern and candlestick pattern traders would see this shooting star happening at a possible double top, and they would open a short trade, which would obviously have worked. However, after price goes down, it comes back again to the same resistance line a third time, as it is shown in the third red arrow. Notice that this time it's a little different. Instead of creating a shooting star pattern, price creates 3 haramis or 3 consecutive inside candles, only to finally give up and start going to the downside again. Chart pattern and candlestick pattern traders would also see this as a setup for a short trade, meaning the combination of a triple top and 3 consecutive inside candles or haramis. Notice the exception here that these 3 harami candles indicate a bearish reversal, but they are bullish candles. This third trade will yield an even greater profit than the second one, as you can see in the chart. Another interesting chart pattern that is not so famous, but it can be very reliable, is called V-bottom and V-top. The V-top is a bearish reversal pattern that is characterized by a sharp acceleration to the upside that is immediately followed by a sharp acceleration to the downside. In this chart, you can see an example of a V-top. Notice how the sharp acceleration to the upside is immediately followed by an acceleration to the downside. At the V-top, it's common to find very clear candlestick patterns that will anticipate the reversal. In this case, we can see an inside candle indicating the beginning of the down movement. The V-bottom is the bullish reversal version of the V-top. It's characterized by a sharp acceleration to the downside that is immediately followed by a sharp acceleration to the upside. In this chart, we can see an example of a V-bottom. The important thing to notice here is that the anticipation of the movement to the upside can be made by observing candlestick patterns. In this case, we can observe several candlestick patterns happening consecutively before the reversal to the upside, mainly inside candles and hammers. As I said previously, there are many different types of chart patterns, and each one of them is traded in a specific way. In this course, I am simply introducing the idea of chart patterns and showing a few of the chart patterns that I find to be more reliable for beginners. If you want to go deeper into the subject, watch the Ultimate Beginner's Guide to Chart Patterns I made in the YouTube card. We have covered a lot of ground so far in terms of raw price action by talking about individual candlesticks and their patterns, highs and lows, trends, support and resistance levels, and chart patterns. Now we must move on to a different part of technical analysis. There are certain things that raw price action cannot tell us, so we need auxiliary tools to access different information about the market. This is where a few technical indicators come into play. One of these aspects of the market that price is not able to tell us by itself is called momentum. Momentum can be defined as the strength behind a price movement. For example, when we talked about trends, we saw that higher highs and higher lows generally mean an uptrend. This uptrend has momentum. In other words, it has the capacity to sustain itself into the future. However, this capacity to sustain itself or the momentum behind a trend cannot last forever. It runs out at some point, and then the market changes direction. The best way of measuring the market momentum is through the technical indicator called RSI, which stands for Relative Strength Index. There are many different things you can do with the RSI indicator, but the best of the techniques to measure market momentum is called momentum divergence. This technique is actually very simple. Remember that as new candlesticks are formed in the price chart, we begin to see the formation of highs and lows. The RSI indicator will mimic the highs and lows formed by candlesticks in a separate window since it's a window oscillator. The trick for you to measure market momentum lies in the comparison between highs and lows in price with the corresponding highs and lows in the RSI. We have basically two types of momentum divergence. The famous reversal divergence, which indicates a reversal in price direction, and the continuation divergence, also called hidden divergence, which indicates a continuation in price movement. For both types of momentum divergences, we have the bullish and the bearish versions. Let's begin by taking a look at the reversal divergence first because it's a little easier to see. We'll start with the bearish version first. A bearish reversal divergence indicates that price will be going up, and then a reversal divergence will appear to signal a reversal to the downside. As we saw earlier, when price is going up, it produces higher highs and higher lows. When there is no momentum divergence, the RSI will also produce higher highs and higher lows. However, as the trend begins to lose momentum, price will continue to make higher highs, but the RSI will fail to create higher highs. That's why we say that the RSI is divergent from price action. Another way of seeing this is that even though the movements created by candlesticks in the price chart might appear to be strong, the RSI will warn that there is not enough momentum to sustain these price movements, and then there is a higher chance that price will reverse direction. In other words, when price is rising and we are looking for a possible reversal divergence, we look at the highs of price in the RSI and ignore the lows. When price starts to create higher highs while the RSI is producing lower highs, we have a bearish reversal divergence signal. Take a look at this price chart. Notice that in the blue lines, price is creating a higher high while the RSI is creating a lower high, therefore creating a bearish reversal divergence signal. Right after that, price reversed to the downside as you can see by the large red arrow. In the bullish reversal divergence, price will be going down, and then a reversal divergence signal will appear to indicate a reversal to the upside. In the bullish reversal divergence, we look at the lows of price in RSI and ignore the highs. The opposite of what we did in the bearish version of the reversal divergence. In other words, a bullish reversal divergence appears when price creates lower lows while the RSI is creating higher lows. In this price chart, we can see a very clear example of bullish reversal divergence. Notice how price creates a lower low while the RSI creates a higher low. Right after that, price reverses direction to the upside. The reversal divergence is the most common type of momentum divergence, but as I mentioned earlier, there's another type called continuation divergence. Like the name suggests, the continuation divergence indicates a continuation in the current price movement, unlike the reversal divergence, which indicates a change in the current price direction. Let's begin with the bullish continuation divergence first. In a bullish continuation divergence, price will be going up, then a continuation divergence will appear to signal a continuation in the upward price movement. For the continuation signal, we look at the lows and ignore the highs. A continuation divergence will appear when price creates a higher low while the RSI is creating a lower low. In this chart, we can see an example of a bullish continuation divergence. Notice how price is going up and generating higher highs and higher lows. While price is generating a higher low, the RSI is generating a lower low. That signals a continuation in the upward price movement as it is marked by the green arrow. In the bearish continuation divergence, price will be going down, meaning you will be creating lower highs and lower lows, and then a continuation signal will indicate that this movement will continue. In the bearish continuation, we look at the highs and ignore the lows. When price creates a lower high while the RSI is creating a higher high, we have a bearish continuation divergence signal. In this price chart, we can see an example of a bearish continuation divergence. In the blue lines, you can see price creating a lower high while the RSI creates a higher high, therefore indicating a continuation in the trend as it is highlighted by the red arrow. The reversal and the continuation divergence signals are among the most reliable ideas in technical analysis. They are surprisingly simple and effective. Another way of measuring the implicit force behind price is through market volume. Volume is similar to momentum in a way. It measures the level of market activity. I say that it's similar to momentum because sometimes a price movement will appear to be strong, but there is not enough volume behind it to sustain the price movement. Like momentum divergence, that is an indication that price reversal might be underway. In the same way that we have momentum divergence, we also have volume divergence. There are several ways of analyzing volume, but the most common of these ways is through what's called the volume histogram. The histogram shows vertical bars corresponding to each candlestick. The green bars indicate the volume in a bullish candle, and the red bars indicate volume in a bearish candle. The higher the bar, the higher the volume in that particular candle. The most important thing about volume comes from one of the tenets of the famous Dow theory. It's a universal rule about the relationship between price and volume. The rule is that volume confirms price movement. That means, for example, that if price is creating higher highs and higher lows in an uptrend, volume should also be increasing. In the same way, when price is creating lower highs and lower lows in a downtrend, volume should also be increasing. Let's summarize that before moving on to the idea of volume divergence. In an uptrend, as price generates higher highs and higher lows, the relative peaks in volume should also increase in order for a trend to be sustained. In a downtrend, as price generates lower highs and lower lows, volume should increase in order for a trend to be sustained. Volume divergence happens when volume doesn't confirm the relative highs and lows in price. In an uptrend, volume divergence happens when price creates higher highs, but the volume histogram creates lower highs. In a downtrend, volume divergence happens when price creates lower lows, but the volume histogram creates lower highs. In this chart, you can see an example of a volume divergence happening in an uptrend. Notice how price creates a higher high, but the volume histogram fails to create a higher volume. Even though the two price movements look similar in terms of strength, if we just look at raw price, in terms of volume, the second price movement is a lot weaker. That is one of the things that led to a reversal to the downside right after, as we can see with the red arrow. In this other chart, we can see an example of volume divergence in a downtrend. Notice how price is creating a lower low, but the relative peaks in volume are creating a lower high. That means that the second price movement down has a lower activity than the first one, which makes it weaker. We can see that price reversed to the upside right after the volume divergence. So far, we only talked about trading techniques, but a good technical analysis course cannot fail to mention money management, as it is a crucial part of trading. It's impossible to survive the market in the long term without the proper knowledge of money management, no matter how well you understand and apply trading techniques. Before we move on to more specific aspects of money management, it should be clear to you that a trade has three types of orders: the entry, the stop, and the target. The entry order is the price that you in fact get in the market. The stop loss order is a price level that you wish to get out of the market in the case of a loss, and the target is the price level you wish to get out of the market in the case of a profit. In the case of a long trade, the stop loss is below the entry and the target is above the entry. In the case of a short trade, the stop loss is above the entry and the target is below the entry. We begin the study of basic money management with the 6 money management parameters you need to keep in mind. They are the initial capital, the percentage risk, which is also known as the F, the dollar risk, the stop size, the trade size, and the risk-reward ratio. The trader must define these parameters in this order. Let's begin with the initial capital. Initial capital is simply the amount of money you have to trade. So if your trading account has $10,000, that's your initial capital. That's all there is to it. The second parameter is the percentage risk, or the F. This is the percentage of capital or the fraction of capital that you are going to risk in every trade. For example, the trader can decide to risk 1% of his initial capital in every trade. The third parameter is the dollar risk, which is simply the percentage risk, or the F in terms of capital. The formula for the dollar risk is capital times F. For example, if the capital is $10,000 and the trader sets the F at 1%, then the dollar risk will be equal to $10,000 times 1%, which equals $100. That means the amount of money you can lose in each trade is equal to $100. The next parameter is the stop size, which is the distance between the entry and the stop loss order. In equities, this is measured in terms of capital. For example, if you open a trade at $20 and the stop loss is at $15, the stop size is equal to $5. Other instruments like Forex and futures are measured in points or pips. For example, in the Euro-USD, the pip is measured from the 4th decimal case. If your entry is at 1.45852 and the stop is at 1.45802, then you have a 50 pip stop loss. This is important for the calculation of the trade size, which is the next parameter. The trade size is the number of shares, lots, or contracts to trade, so that the stop size represents the chosen dollar risk. This is actually simpler than what it sounds. You can know the trade size following very simple formulas. For equities, the trade size is equal to the dollar risk divided by the stop size. In Forex, the trade size is equal to the dollar risk divided by the stop size times the pip value. Notice that you cannot calculate the trade size properly without knowing the stop size, which implies that you cannot trade properly without a stop loss. After calculating the trade size, you can move on to the final parameter, which is the risk-reward ratio. If you want to survive the market in the long term, you need to choose a risk-reward ratio where the target is a few times larger than the stop. As a standard, you can choose a 1-to-3 ratio, meaning that the target will always be 3 times as large as the stop. For example, if you are trading Forex and the trade you want to trigger has a stop equal to 20 pips, your target must be 3 times that, which equals 60 pips. For more advanced traders, the risk-reward ratio can vary according to what happens in the market, but since this is a course for beginners, you must choose a good risk-reward ratio and stick to it. One of the main reasons why a risk-reward ratio like this is important is because you can make money being wrong most of the time. To understand this, you simply need to think about what happens if you make a series of trades respecting a certain risk-reward ratio. Imagine that you use a 1-to-3 ratio, and the first trade you make is profitable. That means you can lose the next 3 trades and still break even, meaning that you can lose the next 3 trades without damaging your initial capital. When we look at a set of trades, we immediately start to look at how many of the trades were profitable in relation to the total number of trades. This is the idea of win rate. In this example, we have a total of 4 trades. 1 is profitable and the other 3 are not. The win rate is simply the number of profitable trades divided by the total number of trades. In this case, we have 1 profit divided by a total of 4 trades, which equals 25%. Notice that this 1 profit is capable of neutralizing 3 losses. That means a break-even, which is when you don't win nor lose any money. What I want you to take away from this is that you can break even with a 25% win rate by using a 1-to-3 risk-reward ratio. In other words, even a win rate slightly higher than that will already produce profits. For example, If you use a risk-reward ratio of 1 to 3 and produce 30% win rate in your trades, you will generate profits. That means you can make money being wrong most of the time if you use a good risk-reward ratio. For example, let's say that your dollar risk is $100 and you use a risk-reward ratio of 1 to 3, so your targets are $300. Let's also imagine that you make 200 trades and you have a win rate of 30%, which is the same as saying that you were wrong 70% of the time in your decisions. 200 trades times 30% win rate means you won 60 trades. 200 trades times 70% means you lost 140 trades. Notice how much larger the number of losing trades is in comparison to the number of winning trades. The winning trades, however, represent a $300 profit each, so the total profit is 60 times 300, which equals $18,000. The total loss is equal to the 140 losing trades times 100, which is the predefined dollar risk, which equals $14,000. If you have $18,000 of profit minus $14,000 of loss, you still have $4,000 of profit even after losing 70% of your trades. This is the reasonable mathematics behind using good risk-reward ratios. Given these simple ideas about money management, we can reach a few conclusions and raise a couple of questions. Number 1, you cannot properly calculate the trade size without knowing the stop size first. That means you cannot trade without a stop loss. Number 2, you cannot calculate your risk-reward ratio properly without establishing a target. That means you cannot trade without a take-profit target. Number 3, once the trade is open, you cannot change the stop loss and take profit orders because that will alter your predefined dollar risk and your risk-reward ratio. You can only do that if you are a more advanced trader. That means you must let the trade either hit the stop or the target no matter what happens. In simpler terms, always use a stop, always use a target, use a good risk-reward ratio. Once you set the stop and the target, don't change them, and finally, let the market hit either the stop or the target no matter what happens. There are two main questions that emerge here. Number 1, how much you should risk in every trade, or what is the optimal F? And number 2, what is the best risk-reward ratio? There are advanced ways of calculating the optimal F, but since this is a course for beginners, we need to keep things simple. The most important thing about risk is that you must keep it low. Do not risk more than 1% of your capital in one trade. Ideally, you should risk between 0.5 and 1% in each trade. Just think that if you risk 0.5% of your capital in each trade, you have 200 consecutive chances of making mistakes before you exhaust your entire capital. You will understand why that's important in the next section when we talk about trading psychology. There are more advanced ideas in order to maximize the risk-reward ratio, but as a rule of thumb, using 1 to 3 will solve most of the problems with money management. We must now move on to another topic that cannot be neglected in a technical analysis course, which is the so-called trading psychology. Beyond trading techniques and money management, traders must also know basic trading psychology principles. The moment you start trading, it becomes obvious that there are many different types of emotions that emerge in trading, especially when you risk real money. Some of the emotions you will face in real trading are hope, optimism, anxiety, fear of losing, greed, fear of missing out, anger, frustration, denial, overconfidence, underconfidence, hesitation, and the list goes on. From this idea that good and bad emotions appear in trading, we can conclude that traders must be able to learn how to manage such emotions efficiently. What a few traders fail to realize is that there are emotions that are possible to manage and others that are unmanageable. The manageable emotions are those you can control with willpower and discipline. Unmanageable emotions are those you cannot control with willpower and discipline. In other words, these are the emotions that take over you and force you to make bad decisions in the market. What differentiates between manageable and unmanageable emotions is not the type of emotion, it's the emotional intensity. Emotional intensity is simply the degree to which you feel an emotion. For example, you can be mildly angry or you can be uncontrollably angry. You can be a little anxious or you can be overwhelmingly anxious. What some traders don't realize about emotional intensity is that there is a certain threshold for it. If you keep the emotional intensity below a certain threshold, any emotion, positive or negative, is manageable by using a reasonable amount of willpower and discipline. However, if the emotional intensity surpasses a certain level, any emotion will become unmanageable. In other words, after a certain degree of emotional intensity, it doesn't matter how much willpower or discipline you have. Whatever emotion you are feeling will become overwhelming. That's where things go wrong in trading. The good news is that traders can control emotional intensity by controlling how much risk they take. In trading, emotional intensity is proportional to F. The greater the F, the greater the emotional intensity. For example, if you risk 50% of what you have in a trade, your emotions during and after that trade will be extremely amplified and too hard to manage, if not impossible. However, if you risk 0.5% of what you have in a trade, your emotions will be easy to manage. The conclusion here is that you don't try to manage amplified emotions. You avoid amplifying them in the first place by risking less. In fact, if you notice that your emotions are getting in the way, it's a sign that you are risking too much. When trading is done in the right way, emotions are actually very easy to manage with minimal willpower and discipline. The bottom line here is that if you want to have control of your emotions in trading, you should use small risk. Another extremely important aspect of trading psychology is the concept of immediate and delayed gratification and punishment. Our perception of risk changes depending on whether the trade we're in is in profit or loss. For example, when you open a trade and it begins to generate a profit, you will immediately feel the urge of closing the trade with that small profit, even if that means losing the chance of making a greater profit by waiting. In other words, you want the immediate gratification. However, if you open a trade and it begins to generate a loss, you feel the need to keep the trade open in the hope that it will reverse and generate a profit. In other words, you want to delay the punishment of realizing the loss. The natural mode of every trader is to realize small and immediate gratifications and to delay punishments in this way. The problem is that this is exactly the opposite of what a trader should do if the goal is to survive in the market in the long term. The correct mode of behavior is to delay gratification and to realize punishments quickly, which is the built-in quality of the money management principles you learned in the previous section. Another way of seeing this is that when we are winning, we are risk-averse. When we are losing, we seek more risk. This is why having clear rules about stop-loss and targets is important. The correct mode of trading is delayed gratification and immediate punishment, but as you see, this is counterintuitive. By following the rules of respecting the stop and targets, where the target is a few times larger than the stop, you are forced to delay gratification and to realize punishment quickly, which is the right way to go. You can only bypass the urge to realize gratification earlier than you should if you use small risk though. Remember that the greater the F, the greater the emotional intensity. Realizing a loss is also not that big of a deal when you use small risk. We can summarize this section about basic trading psychology in a few statements. 1. Use small risk. That will ensure that you will be able to manage your emotions effectively with minimal willpower and discipline. 2. If you follow the risk-reward ratio proposed in this course, and if you follow the rule of letting the market either hit the stop or the target of your trades, no matter what happens, you will solve this problem of delayed gratification and immediate punishment. To put it even more clearly, small risk and clear rules require minimal discipline. High risk and unclear rules are unsustainable and dangerous. Now it's time to put all of these ideas together. In this section, you have an idea of how to combine technical analysis, money management, and trading psychology with a few practical examples. The most powerful concept in technical analysis is the concept of combining trading techniques together, also known as trading at the intersection or the integration of techniques. Trading techniques by themselves are not very powerful, but when you combine them together, they become a lot more reliable. That is an extremely simple idea, but as I said, it's the most powerful principle in all technical analysis. It's a lot more powerful than any single technique you can imagine. Most people who begin to trade believe that it's all about finding the perfect technique. This is the wrong way of looking at it. Traders, from beginners to advanced ones, should strive to combine different types of techniques together. That is as close as you're ever going to get to the holy grail of trading, which does not exist, by the way. So it's not about how great a technique is, it's about integrating the power of different techniques together. It's important to realize that you don't have to combine all the techniques all the time, but the more techniques you combine, the more reliable the trade tends to be. Given the importance of this principle, I want to show you several different examples of trades combining the simple trading techniques you have learned in this course in combination with the money management and trading psychology principles we have seen too. We'll begin with a simple example where we combine two different techniques together: the reversal momentum divergence and the candlestick patterns. Take a look at this price chart. Right from the start, we can see that price is creating lower highs and lower lows, so we can say it's in a downtrend. However, we can also spot a bullish reversal divergence by looking at the lows, as it is highlighted by the blue lines. Price is creating a lower low while the RSI is creating a higher low. As I said before, relying on only one technique is not a good idea, so we must analyze the market through the other techniques as well. The other technique that is clear in this case is the candlestick pattern. Observe that price has been advancing down for a while at each candle, but in the current candle, we have an inside formation or a harami pattern, meaning that price has stopped advancing. By advancing two more candles into the future, we can see two more inside candles. And now the current candle, beyond being an inside candle or a harami, it's also a hammer. This would be a place where you could think about opening a long trade based on the momentum divergence and the cluster of candlestick patterns indicating a reversal. Before you open any trade, however, you always have to think about the stop loss and the take profit order. Stop loss orders must always be placed in a logical price level, and take profit targets should be many times the size of the stop loss. In this situation, the logical stop loss order is below the lowest point in the chart. Notice that if price is going to reverse from here, it's probably not going to break that low, even though it's certainly possible that it does. Notice that none of the candlestick patterns broke that level. Given this situation, you can open a long trade at the open of the next candle with a stop below the lowest low in the chart and a take profit target that is 3 times as large as the stop loss order. Let's advance price to see what happens. As you can see here, the trade is successful. There are a couple of important lessons to learn here about managing the trade while it's open. Notice that in the beginning, price goes down a little bit and it goes closer to the stop level. If you see that happening in real time, you will be tempted to change the stop loss to a lower price level so that the market doesn't trigger the stop. You cannot do that under any circumstances. You can never increase the size of your stop loss order in the middle of the trade because that defeats the purpose of having a stop loss in the first place. You must have the discipline to leave the market hit the stop or not. That's difficult to do, but it's certainly not impossible. It just requires a little discipline. Remember also that it's a lot easier to have this discipline if you use low risk. Right after that, price begins to go in the desired direction, which is up. At this point, your mind will shift 180 degrees, and you will be tempted to close the trade with a small profit. You must also resist this urge. That happens because we prefer a small profit right now, rather than a bigger profit later on. Even though you will feel like closing the trade at this point is the right thing to do, you must resist this urge and learn how to delay the gratification by sticking to the original plan, which is to close the trade at the predefined take profit target. This decision of delaying the gratification right here has a massive impact on your ability to be consistently profitable in the long term. We can also see that the trade eventually hits the target, and then another problem will happen. Even though it hits the predefined target, you see that your target could have been larger because price continued going up. The lesson here is that we can never know if price will overshoot the target or not. In other words, we cannot control that. What we can control is whether or not we let the market hit our target or stop. If you made a trade where the target was 3 times as large as the stop, that's a perfect trade. It doesn't matter if the target could have been 4, 5, or 10 times the size of the stop. There is always another trade you can take. It's more important to make trades like this on a consistent basis rather than producing trades with a disproportional ratio between target and stop. Once again, the name of this game is consistency and balance, not hyper-performance. Let's now move on to another example where we combine three different techniques. Beyond candlestick patterns and momentum divergence, we're also going to add support and resistance lines now. Let's begin with the support and resistance line in this chart. In the green arrows, we can see price respecting the line as support. Then price breaks the line to the downside and transforms it into resistance. As a resistance line, price touches it 3 times once again and breaks it to the upside, turning the line into support again. This is the characteristic switching quality of these lines as we saw earlier. In terms of trend, we can see that price is creating higher highs and higher lows, so we have an uptrend. At the current candlestick, we have an interesting situation. Price is testing the support line once again, remembering that this line has been successfully tested numerous times in the recent past, which makes it stronger. Beyond this, the candlestick that tests the support line is a hammer. Notice the pronounced lower shadow touching and respecting the support line. At the same time, we have a bullish continuation divergence happening in the RSI. Observe the higher low in price and the flat low in the RSI. A lower low in the RSI would be a stronger continuation divergence, but when we have a higher low in price and a flat low in the RSI, there is still divergence. Notice that in this current candlestick, we have 3 distinct techniques happening at the same time. In other words, we are integrating 3 different techniques. This would be enough to open a long trade, but before that, we need to decide the logical stop loss and take profit targets. In this particular trade, notice how we are relying on the buyers that are apparently sitting at the support line. The prominent lower shadow of the current candlestick suggests that. We can therefore place a stop loss order below the low of this candlestick. If we are correct about the buyers at the support line, price should not go lower than this candlestick's lower shadow, even though that is possible with higher market noise. We can enter a trade with a stop just below the lower shadow with a target 3 times as large as the stop. Remember that moving the stop loss order while the trade is open is a terrible idea. You can at best decrease the size of the stop, but that's a more advanced technique. You can never, under any circumstances, increase the size of the stop. Let's advance price to see what happens. As you can see, the trade will be successful. The reward will be 3 times as large as the risk, which is a critical thing for long-term sustainability in trading. Notice that in the second half of the trade, the market started to go sideways, just shy of hitting the target. This is another of those instances where you would have to exercise your discipline in delaying the gratification. This is the 30-minute time frame, so you would have to delay the gratification of an already profitable trade for about 12 hours, which is not an exactly easy thing to do. Let's now move on to another example. This time we'll be looking at a short trade using a combination of chart patterns, support and resistance, candlestick patterns, and momentum divergence. In terms of chart patterns, we can see a triple top formation. The triple top implies a resistance line, as you can see in the horizontal black line. Right at this moment, we are at the third top. This is where the other techniques come into play. In terms of momentum divergence, we have a clear bearish reversal divergence happening as it is highlighted by the blue lines. At the current moment, there is also a clear shooting star formation. Notice that a shooting star also occurred at the moment that this triple top was only a double top formation. Starting from the combination of these 4 techniques, the triple top chart pattern, the resistance line, the bearish reversal divergence, and the shooting star formation, we can open a short trade at the open of the next candle. The logical stop loss order is above the upper shadow of the shooting star. Remember to establish a target that is 3 times as large as the stop, as you can see in this chart. In this next chart, you can see that the trade would be successful. Notice that in the middle of the trade, you probably would feel the urge to close with half of the profit since the market started to oscillate sideways. This is once again the urge you need to learn how to bypass. Sometimes the trade will go into profit territory and then it will come back and hit the stop loss. When that happens, you will be persuaded to close the trade when you feel like it in the next time you try. Do not fall for this temptation. No matter what happens, you need to learn how to let the trade hit the stop or the target. Let's move on to another example. In this one, you will be able to see how we can nest chart patterns in the same way that we can nest candlestick patterns. In this example, we can see a triple bottom formation and consequently a strong support line. In this example, we can also observe a V-bottom formation. Notice how the last movement down is a sharp acceleration to the downside, which is characteristic of a V-bottom. In other words, we have two chart patterns happening simultaneously. In terms of candlestick patterns, we have a couple of things going on. The first candlestick that touches the support line that originates from the triple bottom formation is called a spinning bottom formation, which in this context can be defined as a bullish reversal pattern. The stronger indication comes right after, when an inside candle or a harami appears. Notice how the lower shadow of the inside candle also respects the support line originated from the triple bottom formation. The logical stop-loss order would be below the lower shadow of the spinning bottom formation, which is the lowest point in the third bottom. The target must be 3 times as large as the stop. In this next chart, you can see how this is one of those trades where price simply sets off into profit territory and quickly hits the pre-established target. In this case, you might be tempted to increase the size of your target, but in most cases, the best solution is to stick to the original plan. Let's now observe another example, this time using volume divergence as one of the techniques. In this chart, we can see well-defined lower highs and lower lows, meaning that we have a downtrend in place. However, as I said previously, there are certain kinds of information that raw price action is not able to tell by itself. Momentum and volume are 2 examples of that. In other words, just by looking at the raw price, we cannot tell exactly the strength behind the price movement and the level of activity behind the price movement. Since price is creating lower highs and lower lows, in normal situations, we would expect higher highs in the volume histogram in order to confirm the trend. However, this is not what we observe in this price chart. The volume histogram is creating lower highs instead of higher highs. This is what is known as volume divergence. As price is creating lower highs and lower lows, giving the impression that price is trending with strength to the downside, the level of activity behind the trends is decreasing, which is a sign that the trend might reverse. Another indication that price might reverse and that cannot be extracted directly from price action itself is related to momentum. In the RSI, we can see a bullish reversal divergence happening, which is another indication that the downtrend is weak and about to change direction. This is in agreement with the volume divergence found previously. If we analyze this in terms of candlestick patterns, we can see that there is a hammer formation in the current candle, remembering that the hammer formation is a bullish reversal pattern. This will be a third technique telling us that price is about to reverse. A long trade with a stop below the lowest point in the chart could be opened based on the integration of these 3 techniques. The target must be 3 times as large as the stop, as we can see in this image. Let's fast forward price to see what happens. In this chart, we can see how price starts to rise after the hammer, going directly to the predefined target. Notice that this is not just about the hammer pattern, it's about the context around the hammer pattern, which is created by the volume divergence and the momentum divergence in combination. If you try to trade just the hammer pattern, for example, you will make more mistakes than you should. No technique by itself is strong enough in order for you to trade above the minimum win rate in the long term. This is why the principle of integration and at least basic knowledge of money management and trading psychology are so important for long-term survival in the markets. It's time now to make some conclusions about everything we saw in this course. Number 1. You don't necessarily have to be an advanced trader to make high-quality trades. You can trade very effectively using the techniques you learn in this course. However, learning more advanced techniques will allow you to see more trade opportunities and also higher quality trade opportunities that very few people are able to see in the market. Number 2. Good trading, regardless of being a beginner, intermediate, or advanced trader, is about combining a good understanding of technique, money management, and trading psychology. All of these 3 elements must be present if you want to survive the market in the long term, and there is no reason for you not to seek long-term survival in the markets. Number 3. The most important principle of technical analysis when we talk about technique is the principle of integration. Instead of looking for the perfect trading technique, which doesn't exist, you should strive to combine the power of several good techniques, and there are many good techniques out there. Number 4. As far as money management goes, you should be able to recognize the importance of the stop loss, take profit target, risk-reward ratio, and optimal F. Always use low risk and good risk-reward ratios. That way, you will have a much better chance of becoming a consistently profitable trader. Number 5. You should also be able to understand that your F directly influences your ability to manage the emotions that will inevitably appear when you trade real money. This is yet another reason why you should use low risk, to keep your emotions under a certain threshold that allows them to be manageable using minimal willpower and discipline. Number 6. Before risking real money, make sure you test your abilities in a demo account first. This will allow you to test your technical skills without the influence of emotions that occur in live trading. It will also prevent you from losing money unnecessarily. Number 7. You should be able to develop your skill of delaying gratification and realizing punishments quickly while they are small. This is critical if you want to become consistently profitable in the long term. Most traders have a hard time doing this, so if you can manage to do it, you'll be ahead of most traders already. Once again, this is a lot easier to do when you use small risk. Number 8. High-quality trading is about patience. The techniques you learn in this course are very simple, but you must be able to wait for the right moment to use them, meaning that you must be able to wait for them to align together. Otherwise, your trades will fail more than they should. Number 9. Realize that if your trade failed, it doesn't necessarily mean that you made something wrong. Sometimes you will do everything right and the trade will fail because technical analysis is not an exact science. You have to focus on things that work most of the time instead of all the time. The important thing is to win more money than what you lose. It's impossible to not produce losing trades. It will happen. Number 10. You can make money being wrong most of the time if you use the correct risk-reward ratios. That will give you peace of mind because you will not feel the pressure of having to win every single trade you get into. When you have that mentality, the outcome of your trades will matter, of course, but not that much. You're not looking to have the highest win rate possible. You're looking to have a win rate that is above the minimum win rate determined by your risk-reward ratio. Number 11. Do not try to trade for a living, especially if you have small capital. If you try to trade for a living, you will only depend on your performance to pay for your bills. The problem with that is that performance is variable, while bills and expenses are fixed. If you look at funds, you will see that they have two sources of income: the performance fee, which is variable, and the administration fee, which is fixed. If the administration fee did not exist, most funds will go bankrupt in times of crisis, because that's what will guarantee the payment of bills and expenses during times where the performance is poor, which will inevitably happen. The problem with retail traders is that they can only rely on their performance. They don't have a way to charge administration fees because they trade their own money. In summary, you cannot rely on retail trading alone for a living. You must have a parallel source of steady income. Number 12. Do not treat trading as a business. You must understand the difference between earned income and capital gain. A business is a form of earned income, which makes money when value is provided to a customer in the form of a product or a service. Trading is a form of capital gain, which is a matter of having information at the right place at the right time. Even though the ultimate goal of these two forms is to make money, the way they work is completely different. That's it for this video. I hope this is useful to you in some way. If you wish to take your trading to the next level, please check out my premium courses and ebooks in the video description. You can also send me an email at support@fractalflowpro.com if you have any questions. If you wish to support the channel, please don't forget to click the like button, subscribe to the channel, activate the notifications button so you receive all notifications of new uploads, share the video with your trading community, and leave your feedback below in the comment section. Thank you very much for watching. Take care.